For the longest time, investing was really all about one thing: profit. But what if that's changing? What if your money could actually do more? Like, what if it could help build a better world and build your wealth at the very same time? That's exactly the big idea we're digging into. So let's just get right to it. Can your investment portfolio actually reflect your personal values? I mean, the things you really care about, like the environment or social justice. The short answer is absolutely yes. But, and this is a big but, figuring out how to do it means you've got to wade through a ton of confusing terms. And I'm sure if you've even dipped a toe into this world, you've been hit with this alphabet soup of terms, right? ESG, SRI, impact. They all kind of sound the same and people throw them around like they are, but they're not. So our whole goal here is to make sense of that mess, to give you a clear map so you can actually navigate it. Okay, so here's the game plan. First, we'll talk about this big shift called the new bottom line. Then we're going to decode all that jargon. After that, we'll get into the actual tools investors use, ask the million-dollar question about performance, and wrap it all up by looking at the bigger picture. All right, let's kick things off with section 1, the new bottom line. Forever in investing, the only thing that mattered was that one number at the end of the report, the profit. But that's changing. We're seeing this rise of what people are calling conscious capital. It's this idea that investors are starting to demand a second bottom line. What kind of impact is my money having? And this idea of conscious capital, it's actually pretty simple when you break it down. It's just the belief that your money should help society or, at the very least, not hurt it. It all comes back to that classic phrase you've probably heard: doing well while doing good. It's about getting those financial returns, for sure, but also making a positive difference. Okay, so now that we've got the big idea down, let's tackle the main event, decoding that alphabet soup of jargon. And look, getting these terms straight is super important, because even though they all get lumped together, each one is a totally different strategy for putting your money where your values are. First up, you've got ethical investing. You can kind of think of this as the OG of values-based investing. It's really simple. You draw a moral line in the sand. The main method here is just exclusion. You filter out companies that are into things you're against. The classic sin stocks like tobacco, gambling, weapons. It's basically a do not invest list. Next, we've got the big one you hear about all the time, ESG. That stands for environmental, social, and governance. Now, this one is less about those hard moral lines and way more about data. It's a framework investors use to check out a company's risks. You're asking questions like, what's their environmental footprint? How do they treat their people? Is the company run well, internally? It's a whole system for rating a company's overall health and responsibility. Okay, then there's SRI, or socially responsible investing. Now, I know what you're thinking. This sounds a lot like ESG, but here's the key difference. And it's all about the starting point. With SRI, your personal values are number one. They come before you even look at the investment potential. And a huge part of SRI is what's called shareholder engagement. That's where you don't just sell the stock. You use your ownership to push the company to change for the better. And that brings us to our last term, impact investing. This is, by far, the most proactive approach of the bunch. You're not just trying to avoid the bad guys or reward the good guys. No, with impact investing, you are specifically investing in companies to create a positive and, this is the most important part, measurable impact. You want to see the good it's doing in black and white, right alongside the financial return. So this table here just lays it all out perfectly. It really helps to see the main differences side by side. Ethical, it's all about morals, and the method is exclusion. ESG, it's driven by risk and performance, and it uses data. SRI starts with your personal values and uses engagement to make change. And impact investing, it's all about creating that measurable good. The why and the how for each one, totally different. Okay, so we've got the definitions down. We know the philosophies, but how does this stuff actually play out in a real investment portfolio? Well, that leads us right into our next section, the investor's toolkit. We're going to look at exactly how these strategies are put into practice. So, two of the biggest tools in the toolbox are screening. First, there's negative screening. This is that do not enter list we mentioned before. You just straight up exclude companies or hold industries you don't want to be involved with. Simple. Then you have the flip side, positive screening. Think of this as creating a VIP list. You're actively looking for the best-in-class companies, the ones leading the way on things like climate solutions or social responsibility, and investing in them. But sometimes it's not just about buying or selling. What if you already own a company and you think it could be doing better? Well, instead of just dumping the stock, you can use shareholder engagement. It's about using your seat at the table, your power as a part owner, to push for change from within. And there's a process for it. You talk to them, you set some goals, you check in on their progress, and if nothing changes, then you're prepared to walk away. And all of this leads to, well, let's be honest, it's the elephant in the room, the $1,000,000 question. If you invest this way, are you leaving money on the table? Does doing good mean giving up good returns? It's time to talk performance and principles. So the truth is, there is no easy answer here. This is probably one of the biggest debates in the entire world of finance. I mean, it really all boils down to that one core question you see here. Are these responsible investing factors going to help your bottom line, or are they going to hinder it? Let's look at both sides of the coin. So, on the one hand, the argument for better returns is pretty compelling. The idea is that companies that are strong on sustainability and governance are just well-run businesses. They're better at managing risk, they're more innovative, and they can get the best talent. But on the other hand, the argument for lower returns is just basic math. If you start putting restrictions on what you can invest in, your pool of choices gets smaller. And that might mean you miss out on a big winner in an industry you've decided to avoid. Okay, for our last section, let's pull back and look at the bigger picture. It's really important to understand that this isn't some niche, fleeting trend. Responsible investing is now a huge force in the global markets, and we can actually see and track its impact using real, established financial tools. And if you want proof that this is mainstream, just look at this list. These are major stock market indices created specifically for responsible investing. We're talking about huge household names in finance: FTSE, MSCI, Dow Jones. Now, don't worry about memorizing these specific names. The takeaway here is that they exist. The fact that you can track a basket of sustainable companies just as easily as you can track the S&P 500, well, that is a total game changer. So we've kind of come full circle. We're back to where we began, but hopefully with a lot more clarity. We've gone through the big ideas, we've broken down the jargon, we've looked at the tools. So the question really isn't, can my money reflect my values anymore? We know the answer is yes. The real question now is for you. What impact do you want your money to have?